Today we're talking about something that's not just important, it's critical if you've recently inherited a property. We're breaking down how to handle taxes on inherited property so you can avoid costly mistakes and maximize your gains. Stick around because we're going to cover everything from capital gains to property taxes, and toward the end of the video we'll cover an amazing way for you to avoid renovations and a lengthy sales process when selling your estate. Full disclosure, I'm not a tax accountant. Always consult your CPA before making tax decisions. Before we get started, make sure to hit the subscribe button and smash the bell for more real estate tips. Now let's get into it. First off, what actually happens when you inherit a property? Well, let's break it down. Number one, step up in basis. When you inherit a property, its value is adjusted to the fair market value at the time of the original owner's death. This is called a step up in basis. So let's say your parents originally purchased the property 30 years ago and the house at that time was purchased for $100,000. But today its value has increased to $300,000. For tax purposes, the property's value is now $300,000 as of the date of the inheritance. Why does this matter? It reduces your capital gains tax you owe if you decide to sell. It's actually a huge benefit to the person inheriting the property. You only pay capital gains tax on the difference between the property's fair market value at the time of the inheritance and the sales price. So for example, if you sell that $300,000 property for $320,000, you will only be taxed on the $20,000 increase. Much better than if you were having it be taxed on the difference between the original $100,000 and the $320,000. Big tax savings. Number two, ownership transfer. Ownership of the property is typically transferred to you through a will or a trust. This process often involves probate unless the property was held in a living trust. So here's a big question. Do you owe taxes on an inherited home? The answer depends on several factors. Number one, estate taxes. Good news, most people won't owe estate taxes. As of 2023, the federal estate tax exemption is $12.92 million per person. This means unless your estate's total value exceeds that amount, you're off the hook on federal estate taxes. Number two, property taxes. You'll still need to pay property taxes on the home moving forward. The amount depends on your local tax rate and the property's assessed value. Number three, capital gains taxes. You won't need to worry about capital gain taxes until you decide to sell the property. So much like stocks, until you sell the stock, you don't pay any taxes on it. Taxes only come to play if you sell it for a price higher than the stepped up basis, which is the property's value when you inherited it. On the other hand, if you choose to rent it out or live in it as your primary residence, there won't be any immediate tax obligation. Now that you know the tax implications, it's time to decide what to do with the property. Let's go through the options. Option number one, sell the property. If you don't want to hold on to the home, selling it can be the easiest option. Thanks to stepped up basis, you'll likely pay less in capital gains tax. Option number two, rent it out. If you'd rather generate income, renting out could be a smart move. Just remember, rental income is taxable and you'll need to maintain the property. Option number three, keep it as a primary residence. If you move in and make it your primary home, you may qualify for the homeowner's capital gains exclusion. This lets you exclude up to $250,000 of profit from taxes when you sell, or $500,000 for married couples. All right, let's talk about costly mistakes to watch out for when dealing with inherited property. Number one, not understanding the stepped up basis. Failing to account for the stepped up basis could lead you to overpaying in taxes. Always verify the fair market value with a professional appraiser. Number two, neglecting property maintenance. If you're not ready to sell, you still need to maintain the property. Letting it fall into disrepair could hurt its value. Believe me, this happens more often than you think. I bought hundreds of properties that were inherited, and oftentimes the properties were left in disrepair for months or even years before we purchased them. Number three, skipping professional help. Taxes on inherited property can get complicated. Working with a tax advisor or real estate expert can save you time and money and stress. Think about selling your property? Here's how to minimize your tax liability. Number one, sell quickly after inheriting. If you sell soon after inheriting, the stepped up basis and the sale value are likely similar, which means there's little to no capital gains tax. Number two, track selling expenses. Did you know that you can deduct certain selling costs like real estate agent fees and closing costs from your taxable profit? Keep those receipts. Number three, consider installment sales. Instead of a lump sum, you could sell the property through an installment sale. This spreads out the tax burden over several years. Let's face it, managing inherited property can be overwhelming, especially if it needs repairs and you live out of state. Selling to a cash buyer could be the stress-free solution that you need. The generic cash buyer benefits includes 1, selling as is, 2, fast closings, And 3, a simplified process. And there you have it, everything you need to know about handling taxes on inherited property. Whether you decide to sell, rent, or keep it, understanding these tax implications can save you thousands of dollars and a ton of stress. If you found this video helpful, give it a thumbs up and don't forget to subscribe for more real estate advice. And if you want to learn more about this topic and do a deep dive, check out the links in our description for our blog posts on this topic. Thanks for watching. See you in the next one.